In this presentation, we will take a look at cost variance analysis. First, we'll take a look at the process of the cost variance analysis. It'll look similar to the budgeting process. We'll go through the cycle of the cost variance analysis. We'll have the preparation of the standard cost performance report. So we'll put together, in essence, the standard, which you could think of the expectations, similar to the budget, but this with the cost variance. And then we'll compare the actual cost with the standard costs. So once the time period has then passed, we can take a look at the actual costs, what actually happened, compare them to the standard costs. Then we can investigate the variances or differences, of course, by asking for explanations. We're going to say, hey, here's the variances, here are the differences. What are the reasons? Why do we have these differences? And that, of course, will help us to correct problems that cause unfavorable variances. And we may look into the favorable variances as well. So note that as we consider these items, we're going to be probably more concerned with unfavorable differences, things that don't look good, things that where we performed under what we had been expecting to perform. But at the same time, if our favorable differences are big, are large, then we know there's a problem there as well. It might be simply a problem with the budgeting process because we have some issue with it as well. So we want to look at those differences, whatever those differences are, and then we're going to prepare a standard cost performance report once again based on that new information. So cost variances. Cost variances, the difference between the actual and standard costs. So remember, whenever you see this word variance, it's going to basically mean the difference. And whenever we consider the difference, we're typically comparing what actually happened to what we budgeted to happen. When we're talking about variance analysis, the thing that we predicted to happen, kind of like what we budgeted in essence, the predictions that we had are going to be the standards. So remember, if you see standard, that's going to be what we expected to happen, what we had calculated and estimated that would happen, what we think should happen. And then the actual cost, anytime you see actual, that's what actually did happen. So you got to put your mindset and say, this is the standard. That's what we must have come up with before the time period had passed. And anytime you see actual, you got to say, well, now the time period must be over. And we have the actual numbers and we can compare what we had thought would happen way back when, before the time period had passed, to the time period that had passed and figure out those differences. That's typically the way you want to kind of consider what would happen. The standards, we could think of the standards as we're going to make the standard what we think should have happened at this point in time, at the same point in time. But it's easier to think of the standards as similar to a budgeting process. This is what we think should happen. Then here's what the time period has passed. And then figure out, anytime we have the actual versus the standard, what those differences will be. Now, if it's anything that says favorable difference, will typically be indicated with a large F, favorable difference, and that's where the actual costs are less than the standard cost. And that would make sense, of course, because costs we don't like in terms of financial accounting. So if the actual cost is less than what we thought the cost should be, then in essence we've done better than we had expected in some way, and therefore we have a favorable difference indicated with an F. Unfavorable difference indicated with a large U. Will have the actual cost is greater than the standard cost. So if the cost that actually happened is more than the cost that we thought should happen, the standard, the thing that we should happen under normal conditions, then we have an unfavorable difference. Cost variance computations. We're going to get into some math here. We'll look at the computations. Note this will make more sense when we do examples. So we're just going to go through the formulas first. We'll take a look at the formulas. Then we'll take a look at some examples using actual calculations, and hopefully that'll bring the formulas to life. As we go through the formulas, note that you're going to have these terms, because we're going to have to shorten these things to like CV, AC, SC, and you're just going to have to get used to that because you don't want to have to write out the entire thing, and therefore you're going to have to just learn the terminology. So we have the cost variance or CV, is going to equal the actual cost, AC, minus the standard cost. So in other words, the cost variance equals the actual cost minus the standard cost. And then we're going to have so then we're going to have to consider, what's going to be the actual cost? So the actual cost, or AC, is going to equal the actual quantity times the actual price. So notice we're considering the actual cost, we're breaking it down into its component parts. The component parts, of course, being the quantity times the price per quantity. So the quantity that we have times the price per quantity. And then we're going to have, and we could break that down to AC equals AQ, actual cost equals actual quantity, times AP, actual price. The standard cost then is going to equal the standard quantity, so that's what we would expect under normal conditions, times the standard price, what we would think the standard price is under normal conditions, or SC, standard cost, equals SQ, standard quantity, times SP, standard price. So let's take a look at a couple definitions as we go through this as well. And hopefully these formulas seem, when you look at them, they start to be kind of self-explanatory. They seem to make sense, right? So spend some time with the formulas, but again, you'll get a better idea of them as we go through problems and apply them to the problems. You want to keep this with you for some time, however, so that you get down the lettering and be able to just basically see this information and say, oh, that's cost variance, that's actual cost. And then when we go into the actual formulas, you'll know what those items will be meaning through just the labels with them. So the actual quantity, so AQ, the input, material, or labor used to manufacture the quantity of output. So when we think of actual quantity, we're thinking of it as that we're making things. Remember, we make things, units of inventory, and that includes materials, labor, overhead. We're concentrating here on the materials and labor. We have the actual quantity in terms of material and labor being the units of input that we have, whether that be units of material or typically hours in terms of the labor units. And that's different than, of course, because we're going to have to quantify those. That's not in dollars. We're talking about the materials, that quantity. And then the standard quantity, SQ, is the standard input for the quantity of output. So that's what we would expect to happen. So we've got the actual, what actually happens, the standard, kind of like the budget, the projecting, what we think should happen under the normal conditions. And then we've got the actual price, AP, the actual amount paid to acquire the input, material, or labor. So now we have the actual price. And again, we're considering this in terms of material or labor, the production type of items. When we make inventory, labor, material, overhead, we're concentrating on material and labor. When we consider those, we're talking about the price of material then, typically per unit, and the price of the labor, typically per hour, or that's one way we could put it down into an hourly rate. So we'll have to talk about conversions of hours and whatnot, how long it takes to make something, but that's going to be the actual price. And then we've got the standard price, and that's just the standard price. It's the expected price. It's kind of like the budgeted price, the standard, what we would consider to happen under the normal conditions. General rules for computing cost variance. Now, these rules will make more sense once we apply them to practice, but you'll note as we go through the practice problems, this will be kind of the questions that we often come up. We'll go through the calculations and we'll say, hey, it makes sense. And then we'll get to this kind of items and we'll say, I'm not sure which one to use here. And these are going to be the general rules that we'll then see how they apply once we go through those problems. 1, when computing price variance, the difference between the actual price and the standard price, what we kind of thought it should be compared to what actually happened, the quantity actual is held constant. So we're going to hold the quantity then constant as we look at the price variance, because we're trying to figure out what the difference in the price variance is, and therefore we need to hold the quantities constant. 2, when computing quantity variance, so difference between the actual quantity and the standard, or what we thought should be the quantity, should be, the price standard is held constant. So then we got to hold the price variance because of constant, because now we're focusing in on the quantity. We're trying to see the difference in quantity and therefore need to hold the price constant, and we'll have the standard in that situation. 3, the cost variance or total variance is the sum of the price and quantity variance. So in other words, we're considering the total difference, the total change, and that's you can imagine again the financial statements versus what we budgeted them to be on things like direct material and direct labor. Where if we take direct material, see a difference from the actual to what we budgeted should happen on the budgeted financial compared to the actual financials, that then can be broke down to its components, and the components parts will then add together to get to that total variance. So the cost variance or total variance is the sum of the price and quantity variances. Now we'll go over some alternative types of computations. These could be a little bit longer, but they could make more sense in some ways, so it's useful to look at them. The price variance, or PV, equals the actual price, AP, minus the standard price, SP, if we take all of that times the actual quantity. In other words, if we take the price variance equals the actual price minus the standard price, multiply that times the actual quantity. We'll work some problems in this format as well. The quantity variance, QV, equals bracketed actual quantity, AQ, minus the standard quantity, SQ, times the standard price, SP. Once again, in terms of just the letters, quantity variance equals bracketed actual quantity minus standard quantity times the standard price.